Thanks for joining us for this, for the first of what I hope is going to be a regular series of events that Robot Mascot host, called Inside the Mind of Investors, where we invite a number of active investors onto a panel to answer your questions. And thank you to everyone who has submitted a question for today's session. I've gone through them all and kind of selected some questions for our investor panel to answer, based on the kind of popularity of the question, but also some that I feel often don't get much attention, that are really important things for people to understand. So we'll be going through those later. I'm just going to mute all of your microphones just to make sure that there's no background noise coming through the recordings. But obviously, this means that the investors now have all their mics muted, so I'm going to need them to ask them to unmute their mics again when they introduce themselves to you in a little bit later on. But before I ask the investors on the panel to introduce themselves, I'll just give you a quick introduction to Robot Mascot. So we create pitch materials that convince investors. That's what we're best known for. And our clients are 30 times more likely to raise the investment that they need, having used our service. And because of that, we've ended up being recognised as the UK's leading pitch agency, which is awesome. And our partners like Crowdcube, Seeders, Dent, all position us as their preferred pitch partner, which we really love working with these awesome partners. Essentially, at the heart of Robot Mascot is this concept, this idea that powerful things happen when great innovation meets inspiring communication. Our clients bring the great innovation and we help with the inspiring communication. And when that happens, it has the power to change the world. It can inspire movements, it can build brilliant brands. And essentially, we want to put an end to great ideas failing because of poor communication. And I'm sure you'll hear from a lot of the investors that we're talking to today how important getting that communication right in your pitch and your messaging to investors is vital to your success. And just before we introduce the investors, I just want to say a massive thank you to everyone who bought a ticket for good for today's session. In doing so, you've helped us support women in Kenya to start up their own business, feed their families, feed their local communities, and provide jobs and better housing through the act of entrepreneurship. So a massive thank you to anyone who's bought a ticket for good. Your money all goes towards a project that to date has helped over 550 women to complete a business skills course and created more than $100,000 worth of micro loans for setting up these small businesses. So a massive thank you to anyone who's bought a ticket for good today on behalf of me and Robot Mascot. Final things from me: if you are looking to raise investment, you might want to think about benchmarking your current sort of ability to raise investment, how investable you currently are, and you can do so through our Pitch Ready scorecard, which you can access at pitchready.co.uk, and it's just a few yes or no questions. It takes less than 5 minutes to complete, and you'll get a 12-page bespoke and tailored report giving you some advice on how to improve your current investability. You can get the recording of today's session in two ways. You can either go to our YouTube channel, Robot Mascot, or you can join my Facebook group called Investable Entrepreneur. The recordings will end up on both of those channels. So without further ado, I'll be asking our investor panel to introduce themselves, a quick introduction, and then we'll jump straight into the questions. So James, give yourself an introduction.
Yeah, thanks very much, James. Thanks for inviting us on to the panel today with what I'm sure will be a good chat. So yeah, my name's James. I manage a pre-seed and seed fund based up in Manchester called KM Capital. We are the VC arm of a family office of the founding family behind boohoo.com. So we're quite generalist as a fund. You know, we look across various different sectors, various industries. However, I think we're quite useful to those who are kind of running, you know, maybe an e-commerce business, anything consumer facing, or anything where there might be an angle to perhaps, you know, find a solution for a retailer in like a B2B fashion. So we'll invest anywhere from 50 grand up to 300 alongside, you know, a syndicate of other investors. There's 21 companies in our portfolio to date, and yeah, that hopefully just gives you a bit of an idea about us, our fair Zoopla, Kazoo, and a couple of other kind of consumer retail focused businesses.
Fantastic, thank you, James. Laura, do you wanna go next?
Hi everyone, I'm Laura, and I'm a former retailer, so I was at Selfridges and Kingfisher, and now I'm an angel investor with an angel syndicate called Angel Academy, and we back female founders or co-founders who are starting tech businesses, and I'm also the founder of my own business, which is called Seek, which is a sustainable cleaning business.
Awesome, thank
you. And basically, I back. Sorry, the other quick bit is I back consumer and retail tech. So 2 industries that I understand really well. So that's why I tend to invest in.
Awesome. Myrto, did you want to go next?
Yes, of course. Hi everyone. Really excited to be here. Thanks, James, for having me on this event. I'm Myrto Lalacos. I'm an investment executive at Myrto Ventures. We're based in Manchester, but we invest across the UK, and we're, I would say you're kind of a kind of stage, and we, our ticket sizes are, substantially bigger, so kind of like £750,000 onwards. In terms of sector focus, we're agnostic, so we'll kind of invest in across sector, but we do tend to have a preference for B2B companies. Yeah, I mean, I'll share more about our fund later, but yeah, my background is, I spent 3.5 years kind of running accelerators and programs to help entrepreneurs grow their businesses or connect them to clients, helped to set up a fund at the University of Manchester, started my own business. We've kind of sat on all kind of sides of the table of the kind of entrepreneurship journey. So yeah, right now, currently working as an investor, but it's been, yeah.
Fantastic. And last but not least, we've got Alex from Black Nova Group. So do you want to give us a quick intro?
Yeah, of course. Thanks, James. Hi, everyone. Pleased to meet you. My name's Alex from a business called Black Nova Group. So we're a global venture builder headquartered in Sydney, launched into Manchester about a year ago. So if you haven't heard of a venture builder, it's a way of scaling startups with a combination of capital and services. So the services we provide cover things like go-to-market strategy, product design and engineering. So when I talk about engineering, I'm talking about software engineering. And then we also have a digital marketing arm and recruitment arm. So all those services are interchangeable, can be used as long as you need for exactly what you need. We typically focus on pre-seed and seed stage, and our strength is B2B software as a service businesses in sectors, things like productivity, future of work, cybersecurity, kind of the real kind of tech-enabled sectors. So yeah, my role is country director for Black Nova over here. So I've been launching us into the UK, finding other programs we can collaborate with and support, and just discussing what we do with other startups. So that's us.
Fantastic. Thank you very much for being here, guys. We really appreciate you giving your time to hopefully share some wisdom with all of the founders in the session today. So we're going to start with a question from Martin Barnes, who's asked something that a lot of founders worried about, and he wants to know what the most important part of a founder's pitch is when it comes to building credibility in the mind of an investor. So specifically around building your credibility as a founder. James, do you want to kick us off?
Yeah, it's a tough question because I think there's a lot of, like the way we invest, there's a lot of different sort of maybe 8 or 9 different areas that we like to just get little green ticks in before we, decide to take the plunge. The most important ones, I think your kind of passion around the problem or the business that you're working on, your passion and your kind of domain expertise yourself, I guess, like what do you know about this market, in which you place yourself that someone else doesn't know, and how have you experienced the pain of whatever the business problem is that your business is now solving. So I guess like your kind of command of whatever area it is that you're in, plus your kind of passion and your ability to kind of get us excited about it and I think that trickles through to your ability to get other investors excited about it, your staff excited about it, your customers excited about it. So kind of like passion and domain expertise, maybe I'd say as my top two.
Awesome. Laura, is there anything for you that kind of builds on a founder's credibility?
Yeah, I think I'd fully support that one as number one. I think the other one that there's a couple more that I really look for. One is confidence. So when they're pitching, they know their stuff. They've asked all the questions. Then they're not surprised by questions. They've thought about them, and they might not know the answer to all of them, but they're not surprised by anything. So that kind of blend of confidence, I think, is really important. I often see people that are clearly kind of practicing their pitch or not convinced themselves that it's a good pitch. I think the second one is that I think it's always really interesting that when founders are interested in you, and it should be a bit of a two-way conversation. So, good founders are interested in what you're going to bring to the party, and I think that's always a really good side of a founder, who, if they're kind of prodding you for nearly as much as you're prodding them.
Awesome, thank you, Laura. Alex, is there anything you'd like to add to that? Is there anything particularly that you like to see to build that credibility?
Yeah, I think, echoing what Laura and James have said, it's about that kind of passion and the founder's understanding of what they're trying to achieve. Chances are they're not going to be the first person to try and solve this problem or the last. So it's about how well they can communicate that idea. What gives them an advantage over people in that sector. A lot of what we look for as well is that kind of transparency, like where they know their limits and they're not afraid to ask for help and support. We don't want them to be kind of too green, if you like, where they don't know anything. But at the same, there's nothing worse than founders or teams that are kind of convinced they know it all and don't have any limitations, because that can be quite challenging to work with. So I think that kind of just that humility to not be afraid to ask for help and kind of know where their gaps are, because that's ultimately how we can potentially help them as well. So that's quite big for us.
And just to sort of follow up on some of this thinking, David Suarez has asked, kind of, when it comes to the wider entrepreneurial team, what are you looking for? So across the co-founding team, or maybe just the founder and their first few employees, is there anything different there that you're looking for when it comes to the wider team?
Is that for me, James?
Yes, yeah, Alex, please.
Yeah, sure. Yeah, so just building on that, I think when there's a founding team of say 2 or 3, it's about how well they complement each other's skill sets. A lot of founding teams we see where there's too much kind of skill sets that are too closely aligned, and then there's big gaps over the other parts of the business. So I've met founders where there might be 3 people and they've all come from a very similar background of maybe sales and marketing, similar sector, and it's good that they'll all understand the problem. But what the strongest founding teams for us have demonstrated is that diversity and very different skill sets and problem solving. That gives a founding team that balance. So whether that's different skill sets, so maybe having a superstar product candidate and a sales candidate, and then kind of an operations kind of tinkerer, that's a huge bonus for us, because they're not going to need as much kind of guidance because they'll have those bases covered. Whereas if everyone's kind of stacked to one side of a skill set, it then leaves a lot of work they're going to have to do to kind of fill the rest of that capability of the business.
Awesome, thank you. And Myrto, have you got anything to add on that in terms of the credibility through anything that positions a founder as credible, but also the wider entrepreneurial team?
Yeah, I agree with everything that everyone said. I think all of these things are super important. One more thing that I guess really piques my interest when I'm speaking to a founder and really makes me listen is when they've got that vision of they know where they are today, they know what they're building, what problem they're solving, but they're there and giving you the story of what this could become, and they've thought of all the new markets that they could go into. They've thought of new routes to market strategies, new use cases for what they're building and how it could be used in the future. And I think that really kind of makes a difference in how much attention you give to the founder when they're really able to make you reimagine what the future essentially could look like when this thing that they're building takes off. And then in terms of the team, yeah, I think it's about, depending on which stage, of course, you are at your journey. But for us, since we are a bit later stage, we do expect you to have someone who can sell the product, someone who can build the product, someone who's got the sector experience, who knows the sector you're in inside out. Ideally, if you have connections and you've built relationships in that sector, or at least you're kind of buyer persona, that's a huge plus for us. So we're working on a deal, for example, now where it's a fintech company selling to banks, and the founder has, through his previous experience, worked with 40 of the 50 biggest banks in the world. And that's huge for us. It's, we really buy into that. We know he's connected. We know he can go back to the same people he sold before to sell again. And I guess don't hesitate also to bring up who's on your board, who sits on your board, what connections they have, what their experience is, what they bring to the table. So yeah, just a bit of everything. But again, if you are missing some key team members, investors understand that you do need the cash to kind of create that team. So as long as you're building a team, I used to call it MVT. So we hear about minimal viable product. I think there's a thing called minimal viable team as well, where it's basically saying that you have all the people required to build this product and to grow this company. And as long as you have a really clear idea of what that MVT is and communicate to your investor that, we are missing this person, but with this round, we're looking to bring them in. We've perhaps even started speaking to them and we've identified who it's going to be. We can rest confident that you know what you're doing, you know how to build a team, and that you can take this forward.
I think what I'm getting from this is something that I often talk to our clients about a lot, is kind of having that honest and open discussion with investors, and not trying to present yourself as this ready-made solution where everything's perfect, and kind of saying, we know, this is our insights and experience, this is what we know about our sector and the problem we're solving, but we recognize that we've got gaps here and here, and with your cash, this is where we're hoping to fill those gaps and move forward.
Exactly. And at the end of the day, we're not really investing in your business as it is now. We're investing in your plan of what this is going to be. And as long as you've got a very solid plan, that's what we're putting money into.
Absolutely. I think that's another key point that I often end up talking about is you're painting the picture, that end picture, aren't you, of kind of what this company is going to become, not just what it is now. And it's being able to paint that picture for the investor of what the day of exit looks like, and how big the company is going to be, and what it's going to look like. A bit like, investing in some property. You want to see the plans of the property, not just the foundations of the house. You want to see what the whole development's going to look like before you put your money into it. And I think founders forget sometimes to paint that picture. So when it comes back to James, I think on this one, we've sort of talked about all the things that help build credibility, but a common question that came up, which I found quite interesting, was how big a part your gut feeling plays in making an investment, or is it actually these things that we've just talked about that help form your gut feeling? I
kind of think who you ask on this panel kind of informs the answer to that question, because I think we would invest in a business that might, I think the earliest stage business we might have invested in was probably, it was valued on, let's say, maybe no greater than 300 or 400 grand as a business. So when you're out in the kind of funding world, that's really early. So what have you got to judge at that stage? Most of what you're being pitched at that time is the vision and is the person, and it's very difficult. I think the earlier you go down the kind of investment cycle to people like us who are at the earlier stages, the more you kind of trying to buy into the founder of the business and kind of almost judge them as a person, and it's a very, very difficult thing to do. And I also think, people make the argument, good founders don't necessarily make good CEOs of a big business. So I think there's a lot that can change as a business grows. And I think the earlier you go as an investor, the earlier you're investing, the more you're just kind of trying to weigh up this individual, like how resilient do you believe that they are? How much of a domain expert do you think they are? What's their passion to this? what's the big vision, as Myrto was talking about before. So I think at that early stage, gut feeling does play a little bit of a role. But as you get into this stage of, you know, asking people like Procura Ventures to invest in your business, I think you'll have a nice suite of financial documents and a real kind of business history and lots of traction and track record. Whereas when we're investing, there's less of that. So the earlier you go, I think the more important that is.
How and is it those things that we mentioned earlier in terms of building that credibility in the mind of an investor, the things that kind of sway your gut feeling, being able to be clear about those things?
I think so, yeah. And I mean, as well, I mean, if to what extent has this person's past given them an advantage into running this business in the future? I mean, we see second and third time founders occasionally who we know have kind of scaled up a business before and they can do it again. So that kind of plays into it a little bit too, I think.
How about you, Laura? Because you're sort of an angel investor and sort of at the earlier stages of things. Is gut feeling something that comes into play with you?
Yeah, I think it definitely is. As an angel, it's your money. And it's, you know, you're not having to invest it on someone else's behalf, so you have a bit more freedom, I guess, to go with your gut, which is kind of a good thing and a bad thing, because it means you can kind of run away with yourself when you bloody love a founder and their business. But I'd say it's a big factor, but what I try and do is back it up with facts, you know. So you've just got to, you can lead with your heart, but you've got to get your head has got to catch up, and you've got to look at the numbers. And I think, you know, as an angel, I think one of the, you know, I like to invest in stuff that I can help do. So if I haven't got a good gut feeling and I'm not feeling super excited about the business, I can't be a very good cheerleader. So for me, I've got to feel super excited and my gut feeling has got to be ringing to be able to do it. So, you know, I think that I'm sure it's different if you're managing other people's money.
And does a lot of that, as well as kind of all of this information that they need to deliver to give you that good gut feeling as to that they can actually make this happen, does a lot of it come down to the rapport that they've built with you through the process and their own integrity and honesty through the process?
Yeah, definitely. And I think that's the great advantage. I mean, for an investor perspective, when you're part of an angel syndicate, so I'm a part of an angel syndicate, we all take part in the due diligence. And we've got legal experts and they're, you know, people from the kind of more marketing side and digital side like me. And so each one of us has a view and we come up with a view collectively. And so we use that kind of balance of opinion, and we all individually decide whether to invest, but actually we listen to each other to inform our gut. So I think that's, yeah, and other people, you know, some people are less gut driven and some people are more gut driven. So yeah,
cool. And
it's a number of factors.
Yeah, and Alex, because you're getting involved in both the sort of provision of services to help support as well as the finance. So when it comes to kind of the deals that you do around not just finance, but helping, you know, offering people these services to help them grow their company in return for equity, is that a similar kind of story? It's a lot of it, because it's quite early stages, is gut led.
Yeah, I think, you know, as a business and kind of individually as well, I think we do, you know, sort of believe in that the part of it is that gut feeling, because it is, you know, very early stages that we look at. Some of the, you know, the founders we back are, you know, they're still a sole founder, and the kind of beginnings of their business are just starting to kick into gear, so that they haven't got all these huge metric reports that we can look at and, you know, pick apart. And because we do, depending on how they partner with us, it can get quite, you know, full on in terms of the services we provide, the duration of that relationship. It can range from, you know, a couple of months up to kind of 6+ months. So there has to be that level of, you know, rapport and a good dynamic. And the only way to do that is really just to try and not make rash decisions. I think, you know, so we try and be as thorough as we can in the qualification process. You know, give each other time. It's got, I think, Laura, you mentioned earlier, it's got to be a two-way street. And I'd 100% echo that. You know, it's founder has to buy into us as much as we have to buy into them, because when things get tough, and, you know, startup world always gets tough, so there's got to be that level of kind of trust and gut feeling that, you know, we're going to do right by them, they're going to do right by us, which it just does take a bit of time to build that. It's not the sort of thing I think either side should rush after, you know, a quick half an hour coffee or something. It should be built up over, okay, you know, a period of time where you genuinely back each other and understand what you're trying to bring to the table. That's kind of our philosophy.
Yeah, and Myrto, how does that change? Because you're obviously slightly later in the stage of sort of 750k rounds upwards. How much is led by gut, and how much is kind of traction and kind of the business performance to date?
Yeah, I think it's a good question. Look, we do start off by looking at very objective set of criteria, like how much are you looking to raise? You know, are you based in the UK? Which market are you operating in? And then they get like a quick yes or no based on whether we can physically do this deal based on our investment thesis that we've gone out and fundraised from our investors from. So there's certain kind of complete deal breakers, has nothing to do with the founder, just has something to do with where they're at and what they're building. And then, but we do get a lot of these companies that do fit our criteria every month. And whereas, yeah, I mean, gut feel, it's really funny how you kind of bring this up. And, we tend to say, technology makes things more efficient. Well, gut feel does that as well. So, when you're an investor looking at 50 to 100 decks per month, your gut feel will kind of help you decide on which ones you want to go for and not. You're not going to sit there and go through all the financial projections and all the numbers and the whole deck and read everything. So gut feel at the beginning will kind of change that. So I think that's why you really want to make a really strong impression with your deck. So, you want it to, because, you want it to portray the vision really well. You want it to kind of look clean, especially if you're doing anything consumer facing. If your deck does not look consumer facing, you can't but think the people behind it don't know how to sell to consumers. So it starts out with the deck, and then when you come in person, you just kind of want to be a decent, nice human being. We also do our best, we're kind of at Pretora, and I'm sure, because I've met most of the other investors on the panel, and we try to be friendly. We want to talk on a level, we're in it, we're in this just as much as you are in this as well. So we want to build good relationships, and we want to work with good people. So just be a decent human being, be professional, be honest, show your expertise, and just build that good rapport, I guess.
Yeah, that's brilliant. Thank you all for those answers, because I think there's a lot of, how do you get an investor to have the right gut feel, and that's very much the way that I've tried to. James has read it, my book that's coming out in November, and it's all about positioning yourself as an investable entrepreneur, not just an entrepreneur. It's about creating that gut feel by presenting yourself in the right way with the right information. And I think it's a really important points you'd be making around kind of, yes, there's a gut feel, but all of these things around building credibility in the eyes of investors kind of are helping position yourself so you have that right, you get that right gut feeling from the investors, or you give them that right gut feeling versus everybody else. It comes down to things that you've mentioned there, like the pitch deck and the parts of the projections and the way that they build credibility with their insights. So I think that's really important for, I think, the founders here on this call to understand that, yes, it comes down to gut feel, but you can manufacture that through presenting yourself in the right way and providing the right information, building rapport, having the answers, being honest about where your weaknesses are as well as your strengths. And I think sometimes it's easy to just try and ignore the weaknesses, thinking that that's a negative and you're going to not get investment because of the weaknesses. And actually just that honest and open kind of dialogue with investors is a much better approach than trying to be the hero that's got all the answers. Cool. So kind of moving on, this is something that's sort of come up a lot, and I think it's a really big kind of frustration for a lot of founders that I speak to. Patrick Fullock has asked, what kind of evidence of traction are you looking for in a seed raise? So we hear a lot about getting validation and traction, and it's always kind of, how long is a piece of string? Investors often say, oh yeah, I like what you're doing, but come back when you've got a bit more traction. what is a bit more traction? What is enough traction? I know it's a very difficult question to answer, but I'd like to get your thoughts on kind of, for a typical seed raise, what do you mean by traction? So let's kick off with Alex. What do you think to that?
Yeah, it is the proverbial how long is a piece of string, and I think it really depends on what sector your business is in. What's the opportunity that business is going after? If you're a B2B SaaS company that's targeting your enterprise clients, your traction might be very different to a small consumer marketplace that's just getting booted up. So it's really looking at it on a case by case basis and saying, okay, for the stage that your stuff is at, how much demand have you been able to generate off the kind of minimal resources you have? So, and that's kind of relative to the business. So businesses might come to us with lots of data that could demonstrate traction. It could be clients on a trial basis. It could be generating revenue already. As soon as you start generating revenue from your product, it's an exciting time. I think the key is then how repeatable has that been in the space of time that you've been operating. Has been you had one crazy month where you got loads of signups and never heard from anyone again. That's not really traction for us. Ours is okay. You got a small bite that then turned into a slightly bigger bite, and it's kind of slowly presenting that it can grow. So for us, it's about trying to be as objective as possible, because we are fairly early stage. It's very rare a business will come to us and they've cracked the market and it's all making sense already, or even a kind of anywhere near that. It's often we've got a product, we've had a few thousand signups, we've got a mailing list, we've got the demand there, and we've got lots of intent coming in. That's for us. I think it's businesses that have broken out of that. You're in your bedroom and you've got a few people to sign up to your page. You've turned it into, okay, there's a proven demand here. The idea seems to make sense. It's just how you now scale that and repeat that. That's the kind of stage that we look for. So enough demand to kind of demonstrate that.
Cool. And James, do you want to? How does that differ with KM Capital?
Yeah, definitely. I think a point to make is as well, like that some of the terminology I don't quite like. Like I wouldn't get too hung up on like what an investor who invests at seed will expect to see, because I might see a seed round where a company's raising 300 grand, and then Kazoo does a seed round and it's $80 million or something like that, and the term used for both is the same, but the traction is like entirely different. I think there's a lot of different places that you can benchmark your own business against others. You mentioned before, like places like Crowdcube and Seeders, you can access these platforms and try to find businesses which are similar to your own, see what their plans are, see what their team size is like roughly, see what their monthly revenues might be, their monthly costs might be, and then kind of hold your company up to some of these and figure out, well, am I behind some of my kind of cohort? Because there's every chance that you might be competing for funding with these types of people, or if you approach a sort of seed stage investor, there's a good chance that they're seeing lots of companies kind of similar to this. So I think it's important not to get too hung up on the terminology, and also just try to sort of don't think because I'm doing an A round or a seed round, this is what I need to be over. I would just maybe try to get out into the market, try to talk widely with as many people as you can, and just try and find information on other businesses, and then just kind of hold your business up against these and think, well, this company might have 1,000 customers and they're raising £1 million. I might only have 500 and I was thinking of raising £2 million. So what's different about their business to my business, and try to come at it from that way is what I'd recommend. Brilliant.
And Laura, what does traction mean to you when you're investing in these sort of early stage businesses? What are you hoping to see?
I mean, again, it'll be dependent on the stage of the business. So sometimes they're pre-revenue, it's just a really bloody great idea and it makes sense. And I've tried it. That it makes, there's a huge, sometimes it's like simple things, right? I've gone on their website or wherever it is, I've ordered the product, it's been a fantastic user experience, it's turned up and it's a cracking product. That for me, I don't really need to see sometimes the revenue or all the stats behind it, but it kind of feels instinctively right. So I wouldn't underestimate that. And for me, a lot of those customer metrics are really important. So NPS score for those that have it, or the customer reviews, if they're independent ones through Trustpilot, you know, that for me goes a long way. And then, you know, if they're then slightly more advanced, then not just does the chart go up like that, but are they the customers that, you know, the cohort of customers who built the first lot, have they come back and bought another lot yet? And you know, even that kind of evidence will be really good. So, you know, and that's because I mostly invest in consumer stuff.
And you have invested in some companies that are pre-revenue, have little traction. I think, haven't you? Yeah.
Yeah. So I've done a couple, you know, and there it was, you know, so it was the building a menopause wellness solution for sort of older women. I think it's just a cracking, you know, it just completely makes sense. The founders are great, completely makes sense. I don't really care what the numbers say. I just gut feel, you know, that is a great example of a gut feel investment.
That's where a founder's been able to really get you to buy into their vision. And it's the vision that led to you wanting to invest, not so much the kind of the metrics and the traction that we hear so much about.
Yeah, absolutely. And then actually it's probably a really good example that business then went on and had 6 term sheets from other big, you know, really reputable VCs. So, you know, once you've got it right, actually you don't need to do that much else. You know, it comes to you, I think.
Yeah, fantastic. And Myrto, do you have more kind of benchmark, sort of traction benchmarks that you're looking for, being a slightly later stage of the journey, or is it still very kind of case by case?
I wish we did. It would make my job a lot easier, if I'm honest. And I guess the question with traction is kind of like, okay, well, let's say, assuming that there isn't enough traction, it's, well, what do you have in your business to counter the lack of traction? So because I think that's what everyone is kind of saying one way or another. It's like, okay, well, if you don't have traction, but you have like a top team, connections in the industry, you've got some trials underway, customers are raving about this, you're raving about this, there's a huge market opportunity, and you see the market opportunity. There's no, you know, even we'll go in, right? And we're considered a later stage company, and there are some companies that we're looking at that are pre-revenue, pre-traction, pre-product even, but they have so much to make up for the lack of traction that we don't think about it, and our, you know, any kind of benchmarks or thresholds of revenue and stuff just go out the window because you see the opportunity in this. So I think, I wish there was a benchmark, but I guess the most useful thing I can say is whatever your traction is, make sure that the rest of your business is just, you know, incredible and just speaks for itself and speaks for why you will generate the traction that you know you will generate.
Yeah, so it sounds like what you're kind of all saying really is traction is, yes, it's something you look at, but it's always taken in context with the rest of the overall kind of business plan and strategy, and where you are in the journey, who you are as a founder, and what expertise and understanding you have of that sector, and the whole kind of business case as a whole. And it's kind of taken in regards to everything else that should be part of your business case that you present, that you would have in your business plan, and traction forms one part of it, but it's not the be all and end all. It kind of depends on all these other factors within that strategy. I think that's what you're saying. If that's not, jump in and disagree with me. But that sounds like a summary of what you've been talking about. So so kind of thinking about that kind of overall business case, and traction being one thing, one part of it, but not the defining thing of an investment deal. Talia has asked what the most important thing you look for in investment is and why. So it talks about a lot of different things that you look for, and again, this is probably a different case by case, but do you have one thing that is always a go-to, and if that's not there, it's an absolute no? Do you have sort of something that's always top of the list, and that tick has to be ticked? Let's come to Laura on that one.
I think I've probably talked about it already, which is, for me, it's an amazing customer experience. You know, it's using the product or seeing the product and being wowed by it. I think that's because, you know, you've got lots of stuff about the market and numbers and, you know, yeah, it's probably also the team actually, but you know, if I'm super excited about the thing they're building as a customer, and I'm their target customer, then that's pretty much, that's number one.
It's that vision, that concept, the idea of where you're gonna take this. James, do you have, what's your number one thing that you look for?
Number one, I don't know if I can give you one. I don't know, like team is a big one, like family, like the qualities of the team or the founder, which we've kind of already discussed. The market in which the business kind of sits. I've seen loads of businesses that I love, and I think, you know, if I was out as an entrepreneur and running my own lifestyle business, I'd love to do something like this. You know, I'd love to have the kind of love to kind of have the bravery to go and run this myself. But I think you have to sometimes take yourself out of your own business and think about the motivations of your kind of venture capital investor. If you're talking to a fund like mine or like Protura, that fund is going to assemble a portfolio of, I don't know, 30 or 40 different companies in it potentially. And the way the stats unfortunately work, like a lot of those, like unfortunately just won't make it. So those ones that remain kind of active in that VC's portfolio need to really, really rock it. And if your business is not kind of already placed within a market where that business could potentially scale like very fast, very quickly, then you've kind of sort of set off on a bit of a bad footing almost, if that's the type of investor that you're going for. So I think the market's really important as well. So we've discussed the founding team and kind of credibility, and then the kind of the market as well. Like the market needs to be enormous, otherwise you remove that potential for your business to be that one of the 40 in the VC's portfolio that returns, you know, upwards of 100 times their initial investment. That's how they will think. Because a VC, when it's raising a fund, and we're a bit different from this because we're connected to a family office, but a VC, when it's raising a fund, needs to go and sell itself to a bunch of other institutional investors. It might be pension funds or, you know, just big funds, and the alternative for them is to invest in something a bit safer where they kind of know what their return will be. So for the VC, it needs to find companies that have got that potential to just go ridiculous and 100 times their return in order to make their vehicle an attractive investment opportunity for kind of outside investors. So the market's massive, and like the scalability of a business, it's like the pace at which you need to be able to scale your business up is very important to us as well. So I see some great kind of product-based businesses which might have kind of working capital disadvantages. You know, if you're having to pay 100% upfront for your stock, wait for it to arrive, and then you might market it and sell it 3 or 4 months later, that's quite difficult as well, because I think there's going to be a constant kind of pressure on your business and your whole model. So yeah, founding team, market you're sitting within, and then the kind of scalability or any impediments to you scaling up quickly are things that we need to have before we kind of look at anything else.
Awesome. And Alex, I'm going to flip it on its head now, because Victoria Bond has asked what the top red flags are when looking at a business and deciding not to invest. So, you know, the things we've covered, the things that we're looking for, but what are the no-nos? What are the things you see that are an instant turn off?
The good, the bad, and the ugly. I think the short answer is kind of the reverse of everything a lot of everyone's been saying, but I'll build a bit more on that, I think, because there's so many things that can, you know, flag up in a qualification meeting. You think, hang on a minute, we need to assess that a bit more. But I think there's probably 2 or 3 that come up a lot. I think for us, one of the things we say to founders a lot is kind of in the first, you know, 2 to 3 to 4 years, you'll probably be the most important person in the business. In the next, you know, 3 to 4 years, you'll probably be the least important person. Well, that's where you should be aiming to get to, where you can, you know, shift gears between being that kind of octopus, if you like, doing everything, through to then building a business that's scalable and repeatable. So a lot of the things we look for is a founder that's kind of got that potential, whether that's the knowledge they've got, the humility they've got, the connections they've got. I met a founder once who I mentioned that people might just use Amazon instead of using his idea, and he said something like Amazon will be out of business in 2 years, and I just thought that's a huge claim to make, and I appreciate your ambition, but kind of things like that, you know, just blind blind statements with nothing to back them up, it can be a real kind of turn off. So just always bear that in mind. I think for us as well, because of the stage we're at, it's often founders that think that money is going to solve all their problems, and that, you know, they just need to sign a check and then they'll be fine, which we 100% understand that, you know, capital is super important, and, you know, money in the door can really help. But there's a lot of things that founders and founding teams can be doing for free or off their own momentum or on a much smaller budget. So we like startups that are, you know, quite frugal and aren't looking for this huge check to solve their problems, and specifically not having a clear understanding of where that money is going to go. You know, some of the stats we hear in meetings about how much they're going to spend on this or that, or, you know, this service line or this much on marketing, and there's no real weight behind it and depth to it. It just leaves the impression that they haven't really researched it, and they don't know where this money is going to go, or that they haven't tried to solve that problem a different way, and that they just think if by going out and knocking on a few doors that, you know, the money's going to fall from the trees and everything will be fine. That's probably number one for us, I think, in terms of, you know, a red flag, I think.
So what about you, Myrto? What are the top kind of red flags when you're talking to founders?
Yeah. So yeah, there are a few. I think one of them that isn't discussed a lot is valuation. So we get this a lot that, you know, valuation is hard. It's hard to set yourself a valuation. It's hard for investors to set yourself a valuation. But if you go to an investor and your valuation is just way off the charts compared to what you have at the moment, we might look at it and say, you know, we're not even going to start. We look at this as the starting point from where you negotiate down. And if it's way too high, you kind of go, you know, we're never going to get this to a realistic level. You know, if the expectation is that this is worth 40 million pounds today and all they have is a pitch deck, we're never going to agree on 1 million pound valuation, right? So I think do a bit of research. If you are going to put a valuation in your deck, just do a bit of research to make sure that, you know, you're using the right kind of multiples for your industry, and you're comparing yourself to similar startups in your space and how they grew and how their valuation evolved in the UK. Do not look at the US, because that will lead you a very dangerous path. So I think that's one of them. Don't give, like, it's better if you don't give a valuation at all than to give something that's way too high, because it's just gonna, you know, disencourage people from entering into those negotiations. Another red flag for me, well, I had this the other day where it was kind of like, you know, we kind of marketing type of recruitment agency for Gen Zs, and but they had no Gen Z working in the company whatsoever. And it's kind of like, well, you know, you need to include the people that you're selling to into your business if you're, you know, you know these markets well enough. And I guess, you know, it kind of ties into diversity and stuff. I don't really like it when I receive a pitch deck and, you know, everyone's white and everyone's a man and everyone's wearing a suit. Like, I don't really like it. It's not a red flag, but you really haven't even tried to, you know, kind of create a diverse environment from the beginning of your company. So what's that going to look like further down the line? So just, you know, get a bit of diversity, try to engage with different social groups other than your own, because that's where business is headed. That's what your customers are going to expect from you. That's what the people who you want to hire will expect from you. So yeah, I think, yeah, it's not a red flag, but I just don't like it. Yeah.
Frustration.
Sorry.
No worries. No, that's really, really insightful. I think the valuation point is a massive one, isn't it? It's you're kind of shooting yourself in the foot before you even started if you go in there with a crazy valuation that you can't back up. You just, like I say, you know, there's no point even trying to negotiate, because it's just too wildly far away from what's realistic and what, you know, you're pricing yourself out of the market. Essentially, it's like I often use the analogy that if there's two houses that are identical to each other on a street and they're both up for sale, and one has a value that's twice as much as the other, you really need to see what that house is adding to make you buy that house for twice the value and take out a bigger mortgage to get that house. And it's the same, you know, from a founder's perspective. They just look at their one they're one company, but you're seeing 10 very similar companies often in a day, all at a very similar stage. And if your valuation's twice that of the others, you're instantly kind of going, well, what the hell makes that one any better than these others in terms of the deal that I can get and the return therefore that I can get on my equity, on my shareholding. So yeah, so it's a really important one to get right for founders. So let's move on. We've got a great question. This came up a lot, as you can imagine. Enrique has asked how your investment criteria might have changed recently because of the pandemic and the lockdowns that have been happening. And are there any particular types of startups that you're looking for that perhaps you weren't looking for before the pandemic? So James, do you want to kick us off on that one?
Yeah, well, I don't think our kind of criteria that we're looking for has changed so much. I think you've got to realise like the world is an entirely different place now, and it'll come out of the other end of all this, whenever that is a different place. So you've got to kind of take that in mind. But I don't think our criteria of what we look for has changed too much. I think, you know, the days of kind of growing a business on investor money, you know, building an audience who might then figure out how to monetize or, you know, make some revenue from later on. I think that type of business won't fly anymore. You know, even a company like a WeWork or an Uber or a Monzo who's raised a whole lot of money without a clear path to profitability or, you know, strong kind of unit economics. I think the party's over for companies like that. I think investors will increasingly be looking for really, really clear paths to profitability, quite strong unit economics from the word go. Like, we don't mind, obviously, like, the startup's going to be really quite heavily loss making in the early years, and that's fine, like at the corporate level, but like at the unit level, like what is the, you know, what's the kind of contribution or the profit from you selling one item of your you know, whatever the product is, like what is that today? And if that's loss making now at the unit level, you know, so it's costing you money to make a sale, how do you drive that kind of margin upwards, and what's your clear path to do that? So I think there'll be more of that across the industry, and maybe we might focus a little bit more on that, like stronger unit economics from day one, or like a really clear path to profitability.
Yeah, cool.
Does that make sense?
Yeah, no, absolutely. So Myrto, what are your thoughts? Has anything changed for you due to current circumstances? And I guess the recession as well. We should bundle this in, not just the pandemic, but also the recession and the number of months and years we're going to find ourselves in the wider economy as well.
Yeah, no, so I think the main thing that we want founders to know is how COVID has impacted their sector. So you know, naturally you're building a business in a given sector. And I know it sounds obvious, but we have had it where we were just about to invest in a company, and, you know, 1 month after lockdown asked, well, how's your sector doing? And the founder could not tell us how COVID impacted their sector. So we want you to really, we don't really know how COVID has impacted exactly all the sectors. We want you as a founder to really give us that deep insight that we wouldn't be able to get off the internet. So really know how COVID is reshaping your sector and what that could mean for the future, and really make sure that you can communicate that. Also, we have switched gears a little bit in that before investing, we expect to see longer runways before your cash runs out after we put our money in. So I think we used to be very comfortable putting in money and knowing that you're going to raise again in another year. However, statistically, the number of rounds has gone down across the country. The volume of cash invested has increased, bizarrely, at least in the Northwest, which is the region that we're based in. So you know, there is kind of less rounds being closed at the moment. So we want to make sure that now we've gone from 1 year runway to 2 years runway that we'd expect to see in your business plan, to take into consideration that the market is slower and that, you know, you might have a trouble raising again. And then, you know, going back to valuations, the valuations have dropped across the board. So even if your COVID has impacted your sector not at all, or maybe slightly positive, and, you know, you're not in health, your valuation, market prices have dropped So don't be surprised if investors want to see a drop in valuation, even if your company is doing well, but just to take into consideration COVID, because it's going to take a while for the market to return to pre-COVID kind of valuations, especially at exit. So definitely something to consider.
That's really interesting to hear you say that, because the data that I receive from Seed Legals, one of our close partners, from their data, the deals that they're seeing, they've not seen an impact on valuations through this period with all the deals going through their platform. So that's really interesting that there's different narratives.
Yeah, I mean, crowdfunding valuations are
not crowdfunding, Seed Legals, not Seed.
Seed Legals.
Seed Legals.
Okay.
So these are angel and series rounds. So yeah, interesting that there's different, different kind of opinions on this from different sides of the market. So awesome. How about you, Alex? Anything changed in your with your sort of the position you're in with both providing support and finance?
Yes, I think our kind of criteria and our the caliber of business and founding team we look for, I don't think would ever change. I don't think we'd want to lower that. There's a certain kind of standard we look for. I think what we have probably been open to is that in a lot of this uncertainty, it has created opportunity, and some founders have switched ideas or pivoted and looked at a different route, and it's things like that, or a business has changed its model slightly to look at a different sector, or it's things like that. That adaptability and that resilience is really key, because not everything's written out in this perfect 3 or 5 year plan and you just kind of ride it all the way into exit. It's very rarely like that. So founders that can show that adaptability, show that resilience, not try and sort of turn the oil tanker around if it's too far gone, but being able to adapt and overcome adversity is a really great trait to have as a founder and a founding team. So it's not so much that our criteria has changed, because we would always love to have founders that have got that, but I think those founders have just kind of come to the fore a bit, maybe just by the nature of the market. They've stood out a bit more because it, at least on the outside, it looks like they haven't slowed down too much, and they've just been finding solutions, finding different ways to grow the business and stay and become successful. So I think we've just kept an eye out for those kind of rough diamonds that have come out of this pretty terrible situation for lots of people and found a positive with it.
Yeah. And how about you, Laura? What anything particularly at the forefront of your mind?
So one really small thing, which is, again, because I invest mostly in consumer, I think now more than ever what I'm looking for is companies with really strong customer engagement, so communities that they've been able to build, and loyalty, because actually I think now it's going to get the sort of digital marketing space is going to become more and more expensive, and so people that have lived off that for a long time, I just think are in a trickier position. But actually, if you've got genuinely loyal, super engaged customer base, and you're really great at that, managing your community, I think that for me is a sign of someone who's probably going to weather the storm better than others.
Brilliant. Thank you all. I think, I've obviously been talking a lot to lots of investors and reading lots of reports from various different funds and throughout this period, trying to kind of figure out exactly what's going on behalf of my clients. And I think you've all summarized it perfectly there. And I've kind of identified that if you bundle all this stuff together, everything that you've kind of said about what's happening and how your thinking has changed in regards to your criteria for investment, it kind of boils down to 3 kind of trends that I'm constantly hearing from investors. And one is changing markets. So you've got to understand how the wider economy is affecting your prospects, but also your own individual sector. So you've got to understand and demonstrate you can show how the market's changing and how that affects you positively or negatively, and how you're going to mitigate any risk from it. Changing behaviors, so changing customer behaviors and how that impacts you positively or negatively, and how you're going to respond to it. And then the changing timescales. So Myrto talks about the changing timescales of a funding round taking longer, runways needing to be longer, but also how this whole recession and this pandemic is going to impact on your timescales for growth. And it's kind of, if you can you understand and you can demonstrate to an investor, you understand the changing market, the changing behaviors and the changing timescales within your business, then you're kind of covering the 3 key things that investors want to hear right now about how you're going to handle the current situation we find ourselves in. And I think that's kind of roughly what you were all saying there. So awesome. So that kind of brings us to the end. It's 4 o'clock. We've gone through most of the questions. There's a few we didn't quite get around to, but maybe we'll hopefully we're going to be doing another one of these again with maybe as well. But for now, I'd like to really just thank James, Laura, Myrto, and Alex for joining us today. It's been fascinating to hear your responses. I'm sure a lot of the founders have learned a lot about how you think as investors, and really if you can take that on board as a founder and understand really what it is investors are looking for and hoping to see from a founder, you'll come a long way and be able to create a pitch and start having conversations and negotiations with investors that actually land in a deal rather than a no. So hopefully this puts you slightly ahead of the pack, and you're now got some insights that you can use to develop your fundraising campaign. But yeah, a massive virtual round of applause for our panel, and thank you everyone for joining. Remember that the recording, if you want to check back on some of these insights, will be on our YouTube channel and in our Facebook group. And yeah, thanks everyone for being here, and thank you James, Alex, Laura, and Myrto. And we'll see you all again soon. All the best. Bye everyone.
Cheers.
Bye.
Thanks, James.
Thanks everyone.
Thanks.
Bye.